All right, ladies and gentlemen, welcome back to the Passive Cash Flow Podcast. I'm your host, Aaron Fragnito, and we have an exciting topic. I'm going to make it exciting, called Real Estate Syndication Tax Benefits today. Now, I know that people really don't like talking about taxes. They're kind of boring, but taxes are actually really important. See, I was just talking to my buddy the other day, and he's had a really good year. Very successful real estate broker. He made $400,000. Great year. Good for him. But we were joking about half of it's going to go to the government. And that stinks, all right? Taking home $400,000, working your butt off to get to a level in your career where you finally made it, and half your money goes to the IRS. So how do we avoid doing that? How do we keep more of our money? Because the more you keep, the more you make. First of all, depreciation. Real estate offers tax depreciation. That's the value of the whole entire piece of real estate minus the land, and you can depreciate the building. You can depreciate the building itself. You can even accelerate tax depreciation. You could do something called a cross-segregation study for the buildings that you own, and you can take advantage of the tax depreciation of certain items now rather than later. And that's good because you can use all those tax write-offs now and avoid paying taxes now instead of later. It's also good, maybe you had a good year, you made $400,000, you want to write off some of that income. So tax depreciation is a really great way to write off your take advantage of tax write-offs early on and accelerate those tax write-offs. You don't even have to do a cross-segregation study to take advantage of tax depreciation. You naturally are going to be able to take a certain amount of tax depreciation over the years, and for commercial real estate, it's a certain number of years. For residential real estate, it's a certain number of years, and your CPA will guide you on that. But you're allowed to take an amount of tax depreciation breakout every year. And so you want to also look at the value of a cross-segregation study to accelerate some of that tax depreciation and allow you to get those write-offs earlier and give less money to the IRS now, and ideally do a 1031 tax deference down the road, which I'm going to break into a little bit later on in this podcast. The second way to take advantage of real estate syndication tax benefits is understanding that tax rates at capital gains are lower, right? So my buddy that earned $400,000, now unfortunately, as a W-2 earner or a 1099 earner, he's going to be taxed at a pretty high rate. W-2 earners are the highest taxed rate. Those W-2 earners will be taxed, boy, if you made $400,000, you're looking at about I think 48% tax rate. It's nearly 50%. After you include the state taxes, you're probably around giving nearly over half your income to the IRS, which is really just unfortunate that the tax code doesn't actually reward success. It often penalizes you for earning more. You have to pay more taxes. So that is perhaps one of the backwards spaces in the tax system, but that's just how it works because we need those tax dollars to keep America running. So taxation rates are lower at capital gains. They're often around 25%, where income tax, that's a much higher tax, generally around 40 to 50%. So you want to understand that taking advantage of capital gains tax, if you sell a building, you're going to get hit with capital gains tax. Now that is not a good thing, but capital gains tax is at least lower than income tax. And that's really important to take advantage. If you have to sell a building, take advantage of those capital gains tax and try to not, of course, pay a higher tax rate. And then also on top of the tax depreciation, I want to add to tax depreciation as well. When you have cash flow, right, you're able to write off cash flow with tax depreciation. See, most of our buildings in New Jersey, we don't really buy them for cash flow. They do produce solid cash flow, and every quarter, many of our investors are getting cash flow checks depending on the project. But we don't really buy them for cash flow. We buy them for equity gains over time, because real estate in New Jersey, especially North Jersey, creates great equity growth over time, especially when you're buying at a discounted price, producing value add in the building and forcing equity into the building. You have large equity growth over time. That's growth in the value of the building. Now, this allows you to then do a cash out refinance, and I'm going to talk about how that's tax-free capital as well in a few minutes. But the bottom line is you're able to write off your cash flow with the tax depreciation you're earning. So our investors are often paying no income tax on their cash flow of the building because they're getting an equal amount of tax depreciation every year. So they're able to write off all that cash flow with their tax depreciation. So that's a great advantage of real estate, where if you're getting a dividend on a stock, you're going to have to pay taxes on those dividends. Real estate's different, where you can write off that cash flow with tax depreciation. Also, mortgage interest deductions, right? The interest you're paying on your mortgage can be deducted. And there's a million other costs when you're owning real estate as well. And all those expenses are deductions as well, so that you're really watering down your income on the building on paper using tax depreciation. Also, all the expenses that are naturally hitting your account managing and owning real estate. Mortgage interest is just one of those deductions. And another thing is you neglect a self-employment tax by owning real estate, right? So by owning property syndicators and investors in those syndications are going to be able to earn income on the building and get quarterly checks with the cash flow and large lump sums upon the refinance. So they're going to be able to earn income on these properties, but not have to pay self-employment tax because they're not owning and operating the building. Okay, passive investors are not going to have to pay self-employment tax on those earnings from that investment. So that's just another tax you're going to avoid. But one of the greatest benefits of owning real estate, one of the greatest laws in favor of owning real estate, in fact, this is why I got into real estate, and this is why I'm so excited about real estate syndication tax benefits today, because of the 1031 exchange. Okay, this allows you to sell your building, sell the asset, identify 3 like buildings within a certain period of time, then trade in those buildings. In that period of time, you have to do it right. You have to work with a 1031 exchange company. They're going to hold on to the capital from the sale. 100% of the capital from the sale has to go to that 1031 company. You have to line them up before you close, make sure you do everything right, and then identify 3 properties. You have 90 days to do that, and then I believe 6 months to close on one of those 3 properties, or all those 3 if that's the plan. And that's a 1031 exchange. There is rules and regulations to it. You have to work with a title company that allows you to do this. It's not particularly expensive. It's a great service. It's a great rule. It's an awesome tax law, and it allows real estate investors to trade into bigger and bigger buildings over time. Right? Think about how advantageous this is, right? If Seth and I buy a building for $1 million and 15 years later it's worth $5 million. We go and we sell the building. Let's just say, for numbers' sake, we made a $4 million profit there, right? So in that case, we would normally have to pay about $1.5 million in taxes or so, maybe $1 million in taxes, about 25% capital gains tax at least. So really be nailed in taxes, $1 million in taxes we have to give to the IRS, never to see that money again. But in this case, if we did a 1031 exchange, we sold the building for $5 million, we properly identified another building, we properly bought that building within the 6-month period, and we traded into this bigger building through a 1031 exchange, we'd have that full, $4 million from sale trading into a bigger building. Well, guess what? With $4 million, I can buy, let's say, a $16 million building, okay? With $3 million, I can buy a $12 million building. So right there, that just got me $3 million more of real estate because I'm leveraging that cash from the sale. I'm using a mortgage to buy the next property. So therefore, that extra $1 million I didn't have to give to the IRS, and I can use for the exchange here into my next building to purchase my next building. That's going to allow me a ton more purchasing power. And that's going to, in this scenario, give me another $3 million of real estate, right? Instead of buying a $12 million building, I could buy a $16 million building. You better bet that's a lot better, right? I'd rather own a $16 million building than a $12 million building, right? So it's an amazing tool. You really want to take advantage of it. If you're with a real estate syndicate, understand, are they planning on doing a 1031 exchange? Are they planning on doing a refinance and harvesting those growth over time? Okay, that's what we like to do, the cash out refinance. That means we buy a building for a discounted price, we renovate the building, get it cash flowing nicely, improve the value of it by forced equity, and then we go to refinance the building. We harvest that equity growth, we pay off our old loan, get a larger mortgage amount, a safe amount of debt at a low interest rate, but that allows us to have a lump sum of capital put in the operating account that allows us to distribute out to the investors, and that's a refinance there. We're not selling the building, it's not cash flow, It's debt. Now, it's good debt that's going to be paid down by our tenants for years through a professionally managed piece of real estate. However, the IRS does not tax debt. So by doing the cash out refinance, you can cash out your equity growth, take a lot of cash off the table, disperse out to yourself and your investors in this scenario, and allow your investors to do very well in the investment. That's what we do here at People's Capital Group. We focus on the buy, renovate, refinance strategy. It's a tried and true method. The BRRRR, now there's a fancy name for it because all the millennials are doing it, so we have to name it something cool. Now it's called the BRRRR, the BRRR. So the buy, renovate, refinance structure is what we do here at People's Capital Group. It's a great tax strategy, and that's exactly what it is. See, eventually we're going to do a 1031 tax exchange or tax deference and trade into a bigger property. That way, by refinancing the building and harvesting the equity growth every 4 years or so with our investors, we get a nice lump sum payout every few years. We get to harvest that growth over time. And then we go to trade into a bigger building. We don't get nailed on all those capital gains tax or tax depreciation we took as well through the years. So by taking advantage of all the tax tools out there, the 1031 exchange, not paying self-employment tax, mortgage interest deductions, capital gains tax if you have to sell, of course, it's just a lower tax rate, and tax depreciation. We also talked about a cross-segregation study where you can even accelerate your tax write-offs, take them even earlier, take your tax depreciation earlier than the normal rate. So there's lots of tools out there to pay less taxes, keep more money, and that is the name of the game, right? There's two things that are for sure in life: death and taxes. So if you can own more real estate and pay less taxes, you're ahead of the curve. Go to peoplescapitalgroup.com, learn more. We have tons of articles, tons of podcasts. Hope you'd enjoy this message, and I hope I made real estate syndication tax benefits fun for you today. I know I enjoyed it. Have a good one.